Hi traders, welcome to my video on the Elliott Wave Oscillator, where I'm going to teach you a simple strategy that you can use to capture moves such as this one for over 500 pips and counting. So this is the MT4 MetaTrader 4 trading platform and a US dollar Canadian dollar 1 hour chart. You can use this strategy on any trading platform and any chart time frame, as well as any trading instruments, so Forex, cryptos, commodities, stocks, indices, etc. Okay, I did download the Elliott Wave Oscillator indicator for free, so you can probably find it online if you don't already have it. And the principles that we apply in this strategy can also be used with other oscillators, such as the MACD, for example. Okay, so this is a simple strategy. It's the 1 hour chart time frame, as I said. That's because I like to trade the longer term chart time frames, 1 hour, 4 hour, daily, weekly, monthly, due to the fact that they contain more price data, and therefore I find the signals tend to be more reliable compared to, say, the 1 minute, 5 minute, and 15-minute charts. We can capture big moves like these for hundreds of pips. With plenty of trading instruments to choose from, we don't need to force trades on intraday chart timeframes. It also means less time chart watching, okay, which is great. So the first thing to do is we determine the trend direction. You can see the market here is making these higher lows. Clearly we're in an uptrend. Okay, so once we've done that, then we can just refer to the oscillator here. With the Elliott Wave Oscillator, basically when the histogram, these lines here, are above zero, is said to be in an uptrend. When the histogram is below zero, is said to be in a downtrend, okay? Doesn't necessarily need to be completely on the other side. When you see it drops in value, so when the histogram is falling here, it does also mean that the market can be falling. Just as when the histogram, like here, is increasing in value, it can mean that also the market is increasing. It's just a crossover, is sort of the point that traders like to keep an eye on, okay, for significant market shifts, let's say. Okay, another element to be aware of is divergence. Okay, so when the indicator starts to make higher lows like this, suggests an uptrend, just as when it makes lower highs, it suggests a change to the downside. Okay. Another thing worth mentioning is when the histogram is too far away, it can mean that the market is extremely overbought or oversold. So, for example, if you've seen this move here and you're thinking of selling, well, you shouldn't be anyway, because it's clearly obvious that you'd be selling after a big move. You'd want to at least wait for a pullback. And the Elliott Wave Oscillator can show you that as well, because it's all the way down there. You'd want to wait for a pullback. Like here, for example, you wouldn't have sold there. Wait for this pullback and then sell. You could have sold then on the breakout. Okay, there instead. Okay, same in an uptrend. Probably don't want to buy when it's at its peak. I mean, this wouldn't have been the worst trade in the world, but you would have had ample opportunity to buy all the way up here. So I'm not sure why you'd want to buy at the top. You want to get into a trend as early as possible and maximize the move as much as possible. Okay, so uptrend, covered the divergence, covered the trend direction, the momentum as well. So you have your crossover here, crossover above. We're in an uptrend. Market's made these high lows. And if you want, you can just jump in there. Okay. And in that instance, stop loss below the low, so around 20 odd pips. 20 odd pips stop loss. And you can see this is a real strong trend. I mean, with the 20 pip stop loss and 400 pips profit potential, not a bad trade at all. You can also use, well, I would use a trailing stop. So as soon as the price moved up here, I'd move the stop loss to break even. And then as price continued moving up, I just move the stop loss below the lows all the way up, locking in profit. So when price does turn around, we've maximized the move as much as possible. You can, of course, close part of the position on the way up as well. If you do get taken out prematurely, you can always re-enter. It's just be careful not to re-enter too high. What I wouldn't want to do is have a 20 pip stop loss, see the price move up to here, 50 pips, even 60 pips, get excited. 3-to-1 risk to reward ratio, let me take profit. You're just going to be leaving too much on the table there. When you can get possibly over 400 pips, it would be a shame if you've timed your entry that well to only take 60 pips. So we take what the market can give us. use a tight stop loss so we can cut losing trades short and let winning trades run that way. Even if we are wrong multiple times in a row, when we do eventually catch a trend, can make back them losses and then some more on top. Okay. It's a good feeling to be in a winning position. You know, if you've taken this trade and price is up here and the stop loss is here, you know, worst case scenario, you've made a couple hundred pips and you can just sort of watch your trade play out. It's a good position to be in. And much better than trying to scalp 5 to 10 pips all day long on the 1 minute and 5 minute charts, in my humble opinion. Okay, if you do get taken out with your trailing stop up here, okay, say your trailing stop was below this low, price comes down, takes you out, you can always look to re-enter on a similar signal, which we know the market still making these higher lows. See the crossover, Elliott Wave Oscillator crossover there, and you're more or less in at the beginning of this trend as well. Another 170 odd pips profit potential. Okay, so market timing. If you can get your market timing right, you can capture some big moves. Okay, so what else other than the crossover entry? You may be asking, well, there's a crossover to the downside here, why didn't you take that one? That's because we're in an uptrend. If we see this downtrend continues, then we could look for a crossover, but we're not just going to jump. I'm not going to buy and sell every time it crosses over. Look at this. Crossover, 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 crossover. You don't just buy and sell every time there's a crossover. Here, crossover, crossover. You're just going to get chopped in and out of the market. First thing you need to do is establish the trend direction, okay? And then just trade in the direction of the trend. So it's an uptrend, we're going to look for buy trades. Okay, downtrend. Downtrend, here, we're going to look for sell trades. Okay. This price has started to range here. Nonetheless, it wouldn't have been the worst trade, but we're in a downtrend. If we take the sell crossovers, we will eventually be in on this big downwards move. See, crossover there, you're in. Not to mention you've got that level of support there as well. M pattern formation, breakout to the downside, good trade. What's that? 250 plus pips, not bad at all, okay? Even up here, perhaps a bit early, but nonetheless. Probably would have wanted for the trend to form there, if I'm honest, looking at that. It's a bit more of a range in condition. Probably more like this trade here, the pullback and the breakout there. Which leads me on nicely to the next point is, if you don't want to take the crossovers, I'll just zoom in for you, you can do another strategy, okay? Which is you wait for a pullback. So you wait for the oscillator to drop in value. It does drop here and here, okay? So what happens when it drops is if you mark where it dropped, so that's that inverted hammer there, and then you draw that as your resistance, then you can trade a breakout of that level. So then that's where it dropped. You know that that's the resistance. And when the price moves back above, that's a breakout in line with the trend. It drops here. You just mark the resistance where it drops. Breakout, you're in the trend. Okay. Drops here. So what do we do? Where's the peak where it dropped? Around here. Okay. And you can just trade these breakouts. Okay, where's the next one? Here, big drop down. Peak is here. We can mark our resistance. Resistance then becomes support. Okay, drops here. Mark the peak, which is there. Resistance becomes support. No coincidence. Big drop here. Mark the peak there. Breakout. Okay, pull back there. Mark this resistance, breakout. And then, as I said, when the MACD is high, you don't really want to be buying at the high. Okay, you want to try and get in down when it's low somewhere. Okay, and you know, just looking at the overall trend picture, there has already been quite a significant move up. We had ample opportunity to enter. You don't want to just end up entering too late at the high. There's going to be opportunities everywhere on other trading instruments and timeframes as well. Okay. We just go back to that sell trend. See when it's down here, same thing we can apply. So you can wait for a peak there, a low peak and a pullback, and then you just mark your support and a breakout there. So that's your pullback. Pullback here, mark your support. Support becomes resistance. trade on the breakout or the pullback. Okay, same here, big pullback. Mark your support. Support becomes resistance. Okay. And then we got a crossover entry. The classic crossover entry coincides nicely with the support level. Okay. Ample opportunities. Just need to time your entry. Avoid this. This is just choppiness. Okay. Clear. No clear market trend. Just noise. You know, chopping and changing. Chopping and changing. Yeah, we want to look at this. The range consolidation. If you're range trading, happy days. You know, good for you. You can use the stochastic oscillator or something to try and buy the peaks and troughs. But ideally, we want to trade with the trends, so big trends like this one. Time an entry on a pullback. Don't even need an indicator to do this. Should we do that part of the trend as well? Let's cover that. So pullback. Okay, mark the high. Resistance breakout. There you go. Pullback. Thing about this one, okay, as you can see, by the time the pullback was finished, we'd already had this consolidation. We'd had a drop below. We had the divergence to the downside. So we may have just avoided this situation here and waited for another opportunity, okay? But as you can see, the market's looking a bit choppy. The trades still are there. Yeah, there is still this move upwards. You can, the crossover again, you know, crossover here, and even this pullback on a breakout there. They're just not as cut and dry, just because this is more of a, we zoom in, more of a consolidation sort of up down market compared to this. Okay, this uptrend. All right. What else can we mention? Okay, yeah, I think another thing I want to mention is you don't necessarily need an indicator to do this strategy. If I just remove that, all you really need to do is draw trend lines and support and resistance. So just remove these. I'm a big believer in price action trading, you know, support. Higher lows, we're in an uptrend. Resistance, breakout, resistance, breakout, resistance, breakout, resistance, breakout, resistance, breakout, resistance, breakout, resistance, breakout. I mean, we don't need no unicorn or crystal ball indicators to tell us that. Look at this market. It's choppy. I'm not going to trade it. Oh, look at this. A downtrend. I'm going to trade breakouts of support. I'm not going to buy because we're in a downtrend. How do I know we're in a downtrend? Well, because I can look at the chart with my eyes and see that it's going down. Resistance, downtrend, support, breakout, support, breakout, support, breakout, support, breakout, support, breakout. We don't need no magical indicators to trade like that, okay? Price action trading, I mean, this support line becomes resistance. Any coincidence? I don't think so. Okay? Even here. Look at that. Okay? Downtrend, pullback, breakout, support becomes resistance. You were too late on that trade. Guess what happens here? Pullback, breakout, support becomes, you guessed it, almost resistance. Bang on the line. M pattern. M chart pattern, bearish candlestick patterns, 3 inside down candlestick pattern, bullish candle, bearish candle, 50% of the bullish candle's body, followed by another bearish candle goes below the bullish candle body, another 3 inside down pattern just before that. Okay, the signs are there. Okay, I think if you've just got a good knowledge of price action analysis, the various candlestick patterns, you don't need to rely on potentially lagging or even repainting indicators. But of course, good money management, you can have the best entry in the world. You know, if you're getting in at entries like this and just taking profit here, 20 pip stop loss, 40 pip take profit, great. But look, you could have had over 300 pips to cover any losses you may have had trying to capture trends like this. Same scenario here. How would you feel if you were taking this trade and exited here and then seeing price go 10 times further? You know, could have used a trailing stop and maximize the move as much as possible. You could have re-entered, but the more you re-enter, the more chance you have of re-entering somewhere like this, okay? At the peak. Don't buy at the high, don't sell at the low. And of course, have good trading discipline, you know? Don't let fear anger, greed get in your way, cloud your judgment, make bad decisions. Okay, have a trading plan, stick to it. Don't revenge trade, don't FOMO trade, fear of missing out, don't over trade. Okay, be disciplined and practice on a demo account until you master your trading strategy. You know, you get any bad habits out of the way. As I said, you can use this strategy on any chart time frame. Higher chart time frames, in my experience, tend to give more reliable signals. You can, of course, confirm with different time frames as well. You know, if you're thinking, okay, I'm not sure, is the market moving up here? You can switch to the 4 hour of the daily to confirm the overall trend and trade in the direction of the overall trend. If you insist on trading the 5-minute charts, at least, at the very least, try to trade in the direction of the 1 hour and 4 hour charts. You know, if you see a trend like this and you want to get in for some short-term trades, perhaps then go to the, you might have one long-term entry here and you might go down to the 5-minute and try and pick off a few trades here and there. Personally, I'd rather just capture, well, what was this? How long? A month? I mean, you could have had, with a good timed entry, in the space of a month, you know, over 400 pips. Okay. So maybe trade smart, not hard, I guess, is what I'm trying to say. You don't need to overcomplicate things. You don't need your fancy squiggly wigglies on your chart. But, you know, I respect if that's what you want to do, you know, you do you and trade what in a way that you think works best. Anyway, hopefully you found something useful in this video. If you can like and subscribe, that'd be great and really help my channel. I hope to catch you on the next one. Take care.